How's it going today, guys? So today we're going to be talking about index funds versus mutual funds. It's a question I get a lot of the time from people. Maybe you've heard that mutual funds are not the best possible investment out there. Maybe you've read a couple of books by Tony Robbins and you're wondering whether or not you should still hold the mutual funds you have. Or maybe you're in a situation where you're a young person or you're just looking to invest for the first time, and there's a lot of options out there. You hear about mutual funds, you hear about index funds, and you wonder what you could possibly do here. What's your best strategy? And I'm also going to cover what ETFs are versus index funds, because some people don't realize that, but they are essentially the same thing. It just depends on how you are actually buying them. Now, before I get into the video, I just wanted to mention I've had a lot of people emailing me asking about my stock market mastery course. As you guys know, I had a lot of people enroll in the month of November, so I closed it for the entire month of December, and I just opened it up to my email list. I'm looking to bring on 20 students for the month of December. I'm going to cap it at 20 and then close it again. So if those spots don't get taken up by my email list, I will announce that to you guys and extend that discount. So I'll let you guys know about that, but I'm definitely not looking to bring on a ton of people at once because I spend a lot of time with people working with them one-on-one and answering questions. So I'm not looking to bombard myself with students here. It's more of a one-on-one experience. But if you guys do want to get on the waiting list for my stock market mastery course, the link is in the description below. But let's go ahead and get to the topic of this video and talk about index funds versus mutual funds. So first of all, let's talk about what a fund is. A fund is essentially a pool or a collection of money for a designated purpose. So when it comes to investing, that would be the purpose of investing that money. You pool your money together and collectively invest in certain assets. Now, the reason why people like mutual funds is because most people out there could not afford to pay a financial advisor to manage their money. It's too expensive, and if you don't have enough money to invest, it doesn't make sense for you to be paying someone to make decisions on your behalf. That is where the mutual fund was born, because people were able to collectively pool their money together in what we call a fund, and as a result, they could pay that professional to manage their money as a collective, as a group, and that way it is now cost effective for people with smaller amounts of money to have professional account management. Now, the fund is now broken up into two main categories here. We have the mutual fund, and then we have the index fund or the ETF. Now, ETF, I've done a couple of videos recently talking about Vanguard ETFs. They are my favorite exchange-traded fund out there. But as I just said, an ETF is what is known as an exchange-traded fund. It's a way for you guys to invest in an index fund by buying it as individual shares on the stock market. So just like you go out there and buy a share of Disney stock or Boeing stock or whatever it is, you can buy one share or multiple shares of an actual index fund, but it's like you're buying it as a stock, as individual shares, as opposed to opening a fund. The reason that I like ETFs is because of the fact that it is significantly less expensive to get started, and by expensive I mean the amount of money you actually need or the barriers to entry. So with most funds out there, there's about a $3,000 minimum investment for Vanguard to open up one of their funds through the Vanguard website. So if you don't have $3,000, you can't open up a fund, but you can, in fact, buy shares of that fund through the ETF, and it's going to cost you the price of one single share of ownership. So it's easier for beginners to get involved with ETFs. And me personally, I like having all of my investments in one place if I can. So I like having the ETFs as opposed to having a fund through the website. But I've done a ton of videos about this, guys. I'll link those up at the end if you want to learn more about Vanguard ETFs. But I want to focus more on the difference between these mutual funds that are offered and then these index funds or ETFs out there. So first of all, let's talk about the mutual fund. The mutual fund is an actively managed fund by a professional stock picker. So as I said, a group of people collectively invest their money together, and part of that fund goes to the manager of that portfolio, and they are paid a set amount of money in order to make decisions on your behalf. There are people who are more qualified than you, as they say, and as a result, people trust them to make decisions for them and buy certain things at certain times and sell certain things at other times. So you're paying someone to manage your money. As such, the goal of a mutual fund is to beat the performance of the market. So usually you're going to see mutual funds benchmarked to the S&P 500 index to give you an idea of the performance of that fund versus the performance of the entire market. Now, if you guys have not educated yourself on mutual funds, I would highly recommend looking at the book Unshakable by Tony Robbins, or if you're more ambitious, Money Master the Game is a longer version of that book. It talks a lot about what goes on behind the scenes with Wall Street investors and how the truth is most of these actively managed funds are not beating the return of the market, especially after you consider the expense ratio or what you are paying that professional stock picker to manage your money. So I would highly recommend looking into that, or Forbes did a really good article, I'll link it up in this description below, on the true cost of owning a mutual fund. I'm going to link that up too so you guys can learn more about that. But just understand that most of these funds out there, most of these actively managed mutual funds are not doing what they're supposed to do, which is to beat the return of the market. A lot of them out there are not consistently getting a better return than what you're getting from the market. So the big question is, what exactly are you paying for? If you're paying that professional stock picker to make decisions on your behalf, and they're not even able to beat the market, then what exactly is the point of having active management? So moving on here, as you can imagine, there is a higher expense ratio or cost of that fund with mutual funds, and the average rate is about 0.84% per year. So that means that whatever amount you have invested in that fund, 0.84% of it is going to go to the manager of that fund or to that management company, whoever the fund is through. And so that is money that is not going to be earning more money. That is money that's going to be dragging down the performance of that fund. So again, the goal with a mutual fund is to beat the market. But as we already said, unfortunately, most actively managed mutual funds are not doing a very good job at beating the market. It is an active form of management because you have somebody actually moving around the money and making conscious decisions on their own. And there's also fees associated with mutual funds that you frequently will not find with any index funds or individual stock ownership. The most common ones are the front-end load or the back-end load. So an example of a front-end load would be, let's say you were buying into a particular mutual fund and you put in $100,000, you might have to pay 0.5% or 1% or more, or something like that, as a front-end load, meaning you'd have to pay them $500 to $1,000 just to open that fund as an additional fee on top of that expense ratio. So that's what's called a front-end load, or a back-end load is where upon redemption, you're going to pay that mutual fund company a set percentage. So it's just other ways of incorporating fees, and many people don't realize that there's a front end or a back end load associated with the mutual fund they are involved with. So it's very important to educate yourself on what it is that you're investing in. But understand there are a lot of additional fees when it comes to mutual funds, and it just doesn't make sense to me to pay someone immediately when they haven't done anything for you. So they haven't even made your money into more money. You're trusting them with your money, and they're going to throw a front-end load at you and say, hey, give us 1 or 2% of all the money you're investing, something like that. And then we'll hopefully be able to beat the market for you. So always watch out for that. There's also a cash drag on mutual funds because of the fact that they have to hold a certain amount of the whole fund in cash in case there are redemptions. So that percentage varies from mutual fund to mutual fund, but understand that at any given point in time, a certain number of these people involved in this fund are going to make the decision that, okay, I'd like to sell my fund, sell some of the fund and get my money out. So what they need to do in order to have liquidity is hold on to a certain amount in cash. That way they can give people their money without having any delays or problems. And that is all money that is just sitting there in cash. It's not earning any rate of return. And as a result, that is what you call a cash drag. There's also a tax drag associated with these investments because oftentimes when the fund is reallocated, a lot of the changes fall under short-term capital gains. And as we've talked about before on my channel, you have both short and long-term capital gains, and the tax rate can be as much as a 20% difference depending on what tax bracket you fall into in the United States. So if you have capital gains that are falling under short-term capital gains instead of long-term capital gains, that could be a significant tax drag on your account where you're paying a higher rate of taxes just due to the fact that there are short-term capital gains being recognized. And then the final thing you will find with mutual funds is that because they are actively managed, you're going to have more movement, more allocation, reallocation, buying and selling, and that is going to generate transaction costs. So you're going to be paying more transaction costs from the buying and selling of different investments within that fund. So that is what is typical of a mutual fund. And as we said, guys, most of them out there are not doing what they're supposed to do, which is to beat the return of the market. So now we're going to talk about index funds or ETFs, and I hope this is the section that's going to interest you guys. I pretty much recommend ETFs, Vanguard ETFs, to everyone out there. Unless you're looking for some kind of specialty or, I don't know, industry-specific ETF, I would stick with what Vanguard has to offer. They have some of the cheapest funds, and I've said this many times before, I am in no way affiliated with Vanguard. I don't get a kickback for recommending them. I use them myself, and they have some of the best products out there. But basically, guys, an index fund tracks an underlying market index. So like we have the S&P 500, or we have the NASDAQ, the New York Stock Exchange, the Dow Jones Industrial Average. What they do is they track the performance of that market and they replicate it as closely as possible. So if you were to invest in, for example, VOO, which is the Vanguard 500 fund, that fund is going to very closely replicate the performance of the S&P 500. So the goal of an index fund is not to beat the market. The goal is to replicate the performance of the market. So at that point, as opposed to trying to beat the market, you're just going to own the market because you are conscious and aware of the fact that most actively managed funds fail to do this. So your best strategy is just to own the market. They do have a much lower expense ratio due to the fact that you're not paying for active management. These are passively managed because the only time the investments change is when that underlying index changes. So if there were changes made to the S&P 500, a new company was added and another one was removed, then that fund would be changed. Or if you were investing in a fund that tracked the Dow Jones Industrial Average, if there were changes made to that index at that point, that fund would change. But other than that, it is passive, and there are not frequent changes being made to the investments within that fund. So on average, the index funds have a 0.11% expense ratio compared to a 0.84 of the actively managed mutual funds. And the other thing that's good about index funds is the fact that due to the fact that you don't have to worry about having that cash sitting there, because also what's worth mentioning is the fact that oftentimes mutual fund owners will hold on to cash in case a buying opportunity arises. They always keep some amount in cash, whereas you're always going to be 100% invested with an index fund because you're not waiting to buy something because you're only trying to replicate the performance of a certain index. And also due to the fact that the only time the index fund changes is when the underlying index changes, you're going to have a lot less transactions and a lot less transaction and commission costs as a result. So anyways, guys, that is the difference between these things, mutual funds and index funds. If you're considering looking at a mutual fund, I would highly recommend looking at the performance over the last 5 years or 10 years and seeing if they have a consistent track record of beating the S&P 500 after you consider what the expense ratio is and any other fees like a front-end load or a back-end load. But anyways, guys, that is all I got for this video. I hope you enjoyed it. Let me know in the comments section below if you guys are invested in any index funds. I would be curious to hear your recommendations. If you guys enjoyed this video, please drop a like. If you're new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video.